Hi, I'm Pattu from freefincal. As viewers may know, I have been disclosing my stock portfolio every month, and this is the January 2021 portfolio. And this time, I have compared the performance of my portfolio with the Nifty 50. Until last month, I had problems calculating the returns, and then in the next close to the December audit, I had posted the returns. You may remember. So from now on, hopefully, the returns also will be updated every month. And I want to make it very clear that this is not an investment advice. I have achieved all my goals, and I started out doing the stock portfolio uh, purely on an experimental basis. Of course, the amount invested has increased now, but still I don't spend too much time on researching and investing. I just call it some form of lazy investing. And Rob Arnott in 2013 produced a paper called The Surprising Alpha from Malkiel's Monkey and Upside Downside Strategies, in which he showed that 96 out of 100 randomly generated portfolios, or what he calls as monkey throwing darts portfolio, they bet the index. This is a reference to a quote from A Random Walk Down Wall Street, where it's written as: a blindfolded monkey throwing darts at a newspaper's financial pages could select a portfolio that would do just as well as one carefully selected by experts. So Rob Arnott actually showed that a monkey can not only match the index, they can actually beat the index because of random suggestions. And this is one such monkey portfolio, in my opinion. I don't want to discuss the efficacy of such a monkey portfolio. I'm not capable of doing that, but I'm very sure that my portfolio is fairly a monkey portfolio. It's based on low volatility investing. I always wanted to invest in stocks without too much of balance sheet research and so on. So I mean, I was not comfortable doing that until I read about the strategic indices or the smart beta indices. One of the strategies, the low volatility strategy, where you basically look at the last 1 year volatility in the price and invest. Instead of just looking at that alone, we also look at the basic company health, whether its debts levels are low and so on. So I had shown this picture, and also mentioned about how I pick stocks. I don't do any kind of analysis or evaluation. I check for low volatility. I ensure they have reasonable financial health. The low debt is important. And generally, try to buy stocks that are trading close to their all time highs. Not all the stocks in my portfolio are like that. For example, ITC. But their financial health and low volatility is important. I think now all the stocks in my portfolio are now part of the Nifty 100 low volatility 30 index. Therefore, many of them are expensive. I don't care about that. I don't care about the price. I like buying expensive stocks that are trading close to their all-time highs. There's no problem in that. And I also don't care about whether they are dividend payers or not. It just doesn't matter. That doesn't matter. It's the same thing. And although there's nothing extra in the form of dividends is a realized gain instead of a notional gain. And at my age, it's easier for me to appreciate that. And that's about it. The rest of it is all available there. I have not said anything new. So this is the normalized cumulative investments made. So if I have invested a total of 1 rupee, let's say as of January 8th 2021, the 60 paisa of out of that 1 rupee, or 60% of my total investments, were made in the last few months, in the last 2 quarters of 2020. And so it's a very young portfolio, so don't worry too much about returns and so on. So it's not something that I am going to make a big deal about. The only thing I make a big deal about is that I did it by very minimal analysis. In fact, zero analysis. I have already said that I use the simplywall.st portfolio app for tracking my returns and so on. So this is the weights: Hindustan Unilever 17.8, Asian Paints 17.7, TCS 14.8, Infi 11.1, Pidilite 10.5, HDFC Bank 9.7, Dabur 7.9, excuse me, Colpal 4.6, ITC 3.2, Marico 1.3, Wipro 1.3. I need to increase this a little bit. I do look at the volatility primarily. Sometimes I also get I should say influenced by the stock's momentum, how much the stock has gained in the past few months and so on. I use my screener for it, but not too much. My primary goal is only momentum, and I just at least as long as these stocks remain part of that Nifty 100 low volatility 30, I'm fine, because it's easy to pick a stock, but once you start running a portfolio, what happens is you have to have a exit strategy. When are you going to throw out a stock? When are you going to add a new one? And how to minimize churn, how to minimize taxes, and so on. All those become important. So as of now, I have not had that kind of difficulty. I've been trying to manage these weights just by changing the investment amounts. But that's about that. So these are the returns. Don't take this too seriously. I mean, somebody wanted to see it, so I did this comparison with Nifty. For the portfolio, stock portfolio, the absolute returns are 24.93%, dividends 1.05. If I add them, it's 25.98. The CAGR numbers are too high, but they won't last that long, so don't worry too much about it. In comparison, UTI Nifty direct plan growth option 17.43% is the absolute return. That's the CAGR. The Nifty total returns index, where this one doesn't have any kind of expense ratio in it, this is a little bit about 0.3, 0.4% higher. That's about it. Approximately. These are very approximate numbers. But as of now, this monkey portfolio has reasonably outperformed the Nifty. But that's just sheer dumb luck. Don't take this as investment advice. I'm just showing you what I'm doing. Low volatility investing is a reasonable way for a newbie to start investing, but they should have a proper plan. Bye bye.